Ryan built something you could see. A house with a lockbox on the front door. A tenant who paid rent on the first of every month. A story he could tell at every dinner party for the next 2 decades. Ethan built something invisible. A number on a screen that went up, then down, then up a little more. His coworkers changed the subject when he brought it up. Nobody asked him about it at parties. Nobody was impressed. 20 years later, the invisible thing won. Not by a little, by a number that changes how you think about every financial decision you have ever made. And the number is not the most surprising part. The most surprising part is the cost that nobody counted. Ryan and Ethan are 30 years old. Same city, same company, same salary, $55,000 a year. Both of them have exactly $50,000 saved. The only thing different is what they do with it. Ryan uses his $50,000 as a 20% down payment on a $250,000 rental property, a solid 3-bedroom house in a decent neighborhood. He locks in a 30-year mortgage at 7% interest. His monthly payment comes out to about $1,330. He finds a tenant willing to pay $1,800 a month. On paper, Ryan pockets $470 every month before expenses. Ryan feels like he cracked the code. Ethan takes the same $50,000 and moves it into a total stock market index fund. He sets up a $300 automatic contribution every month. He gets a confirmation email. He goes back to his life. Nobody asks Ethan about his investments at dinner. Nobody is impressed. But here is what most people forget. Feelings and math are 2 completely different systems, and over 20 years, only one of them wins. For the first 3 years, Ryan is winning every metric that matters to human beings. Rent checks arrive on the first of every month. He drives past his property on the way to work and feels something. His tax return improves because of mortgage interest deductions. His equity grows with every payment. Home values in his neighborhood are ticking upward. At every barbecue, every family dinner, every casual conversation, Ryan is the guy with a plan. Marcus, his old college friend, asks what Ryan is doing with his money. Ryan says, "I own a rental property." Marcus nods. "That sounds smart," he says. Meanwhile, Ethan watches his $50,000 grow to about $55,000 in year 1, then $61,000 in year 2. Nothing dramatic, no key in his pocket, no property to point to, just a number that quietly changes every quarter. No one asks Ethan what he is doing with his money. The social score is not close. Ryan is winning, and for the first few years, the numbers agree with him. By year 3, Ryan has collected roughly $64,000 in rent. His mortgage payments total about $48,000. That leaves $16,000 in gross cash flow. Not bad. But here is where the napkin math starts showing its edges. A water heater fails. $1,200. Gone on a Tuesday afternoon with a single phone call. 3 months of Ryan's projected profit erased before he even knew there was a problem. Then the roof shows damage from last winter's storm. The contractor quote comes back at $8,500. Ryan did not budget for this. Nobody told him to. Then a tenant moves out. 1 month vacancy. Ryan pays the full mortgage on an empty house. Cleaning costs. Listing fees. 2 weeks of showing the property on his weekends. His actual net profit over those first 3 years, after every real cost, is somewhere between $2,000 and $4,000. Not the $16,000 that looked so good on a napkin. Ethan's portfolio at year 3, with his monthly contributions, is sitting at around $90,000. He spent 0 hours on any of it. But here is why Ryan keeps going, and why he is not wrong to keep going. Because Ryan has something Ethan does not. Leverage. That $250,000 house is now worth about $275,000. Ryan used $50,000 to control a $250,000 asset. When the value goes up even a few percent, the gain is on the full value of the home, not just his down payment. That multiplier effect is real. It is the single most powerful argument for real estate, and it cannot be dismissed. Comment A if you are in Ryan's situation right now. Comment B if you are on Ethan's path. Comment start if you have not made this decision yet. By year 5, Ryan has replaced the roof, handled a plumbing emergency, gone through his 3rd tenant, and raised the rent to $19.50 a month. His real cash-on-cash return after all actual expenses is hovering around 3 to 5%. Not the 20% he quoted at the barbecue, but not zero either. He is building equity. He is building something. And in year 5, that feels like enough. Ethan's portfolio has quietly grown from $50,000 to somewhere between $135,000 and $150,000. He has contributed $68,000 total over 5 years. The remaining gains are pure compounding. He spent exactly 0 weekends on any of it. Year 10, the midpoint. Ryan's property is now worth roughly $340,000. His remaining mortgage balance is $166,000. That puts his equity at approximately $174,000. After 10 years of maintenance, repairs, insurance increases, property tax hikes, and one difficult tenant who left the floors damaged on the way out, Ryan has spent somewhere between $20,000 and $35,000 beyond his original down payment. Ethan's portfolio, with consistent $300 monthly contributions at roughly 10% average annual return, is sitting at approximately $165,000 to $180,000. He contributed $86,000 total. The rest is compounding. At year 10, they are nearly even in total wealth. Ryan might be slightly ahead because of leverage, but here is the number that nobody counts. Not a dollar amount. Something more expensive than money. Ryan spent an estimated 2,000 hours over the first decade managing his property. Phone calls, showings, coordinating repairs, reviewing lease agreements, arguing with contractors, appearing in person for issues that could not wait until the weekend. 2,000 hours. If Ryan's time is worth what his salary suggests, somewhere around $25 to $30 an hour, that is $50,000 to $60,000 of unpaid labor that never appeared on any spreadsheet. Ethan spent those same 2,000 hours doing other things, building other skills, sleeping through the night. Now, Ethan is not a superhero. In year 8, the stock market dropped 15% in 4 months. Ethan watched his account balance fall by over $20,000 in a single quarter. His friends called him. His brother told him to sell before it got worse. His own hands moved toward the keyboard. He did not sell, but it was not easy. The path Ethan is on has its own tax. It is not paid in dollars. It is paid in sitting still while people you trust are telling you that you are making a mistake. Comment A if you are Ryan. Comment B if you are Ethan. Comment start if you are still deciding. The first 10 years were about money. The next 10 are about something else entirely. Year 11. This is where the story fully separates. Ryan stands at a crossroads. His property has appreciated significantly. He could sell right now, take his equity, pay the taxes, and shift his entire financial position into something liquid, something flexible. He has approximately $170,000 in paper gains. He could walk away, but the tax code has a lever designed specifically for this moment. It is called the 1031 exchange. Here is how the system whispers to Ryan. It says, do not take the money. Roll your gains into a bigger property and we will defer your entire tax bill. Not forgive it, defer it indefinitely. Ryan does not see a trap. He sees an upgrade. He sells the house and purchases a 4-unit apartment building. He is now a multi-unit landlord. On paper, his net worth has expanded dramatically. He feels like he leveled up. What he actually did was multiply his liabilities by 4. 4 roofs that can leak. 4 HVAC systems that can fail in January. 4 sets of tenants with 4 sets of problems. 4 times the probability of a midnight phone call. 4 times the insurance. 4 times the property tax. 4 times the exposure to a single local economy. Ryan did not build more freedom. He built a bigger machine that requires him to operate it continuously. Ethan, in year 11, has crossed a threshold that most people never reach. His portfolio has passed the $250,000 mark, and something has shifted mathematically. The daily fluctuations of the market now move more money in a single afternoon than Ethan contributes in an entire year. Compound interest has crossed from slow drip to strong current. His wealth is no longer growing primarily through his contributions. It is growing through its own momentum. In year 13, Ethan spends 2 weeks in Portugal. He does not check his account once. Year 14. Ryan is on a call with a contractor about a mold problem in Unit 3 of his fourplex. The building is worth close to $900,000 on paper. He owes $600,000 to the bank. By any definition, Ryan is a wealthy man. He has not taken more than 3 consecutive days off in 4 years, because something always needs his attention. I know some of you are going to disagree with what comes next. Leave your argument in the comments. I read every single one. Year 17. The stock market drops 35% in a single quarter. Ethan watches $260,000 disappear from his account in 90 days. His phone rings. His friends call to offer condolences. They tell him his paper wealth has vanished. Ryan, watching from the stability of his brick building, allows himself a quiet moment of satisfaction. He has something real, something that does not crash in a quarter. He is right, and he is also completely wrong. Year 18. A major employer in Ryan City announces it is relocating its headquarters. Within 6 months, the local rental market weakens significantly. 2 of Ryan's 4 units go vacant. He cannot lower rent enough to compete without making the mortgage impossible to cover. For the next 14 months, Ryan writes a personal check to cover the gap between his rental income and his debt obligations. $3,000 a month, out of his own salary. $42,000 in total. The safe investment in bricks turned out to be a concentrated bet on a single zip code. When the neighborhood weakened, Ryan weakened with it. Bricks can disappear too. They just do it slowly. Year 20, the final count. Ethan's portfolio, after the crash and the recovery and the years that followed, stands at approximately $420,000 to $460,000. He contributed $122,000 over 20 years. The remaining $300,000 plus is pure compounding. No debt, no tenants, no repair bills. He clicks a button. He transfers $48,000. It arrives in his account in 2 business days. Ryan sells his fourplex for $1.1 million. He feels like a millionaire. Then the mortgage is settled. Then the real estate agent commission at 6%. Then closing costs and legal fees. Then the IRS collects its deferred bill. Everything Ryan postponed through 2 decades of 1031 exchanges and depreciation claims. Ryan walks away with somewhere between $400,000 and $500,000. On paper, they end up in the same range. But look at the full accounting. Ryan spent an estimated 2,000 to 3,000 hours over 20 years managing, coordinating, worrying about, and attending to his properties. If his time carries the value it should, that is between $100,000 and $200,000 of unpaid labor that never appeared on a balance sheet. Ethan spent those same hours building other things. Ryan did not make a stupid decision. He made a reasonable decision with incomplete information. Nobody handed him the full spreadsheet. Nobody told him to count the hours. Nobody explained that the 1031 exchange was a deferral, not a forgiveness. The system was not designed to tell him all of this. Ethan did not get lucky. He got bored. And bored, it turns out, was the right strategy. Here is the question I am not going to answer today. What happens when you do both at the same time? When you own real estate and invest in index funds simultaneously? The math on that combination is not what you would expect, and it changes based on a few specific variables that most people get completely wrong. If you want to know what those variables are, comment the word both below. If enough people ask, that is the next video. And if you are Ryan right now, leave a comment telling me what year you are in. I read every single one, and I will tell you what the numbers say about where you stand. The math is never finished until you count everything.